Stocks in China are in the red as monetary authorities in Beijing held off on cutting interest rates, which would have given the world's second largest economy a boost. Instead, the Chinese central bank has announced more modest stimulus measures aimed at helping homeowners, small businesses, and logistics firms. Prospects for the economy have dimmed due to an extended lockdown in the financial and trading hub of Shanghai and other major cities. Those coronavirus restrictions have kept millions of people stuck in their homes and forced factories to suspend operations. China is currently grappling with its worst outbreak of COVID-19 since the initial wave in 2020. And earlier this week, the International Monetary Fund slashed its GDP growth forecast for China, adding that a slowdown there, together with the crisis in Ukraine, would have global implications.
The latest lockdowns in China could cause new bottlenecks in supply chains. In this context, beyond its immediate and tragic humanitarian impact, the war will slow economic growth and increase inflation. Overall economic risks have risen sharply, and policy trade-offs have become even more challenging.
Now, for more on the story, let's go to Craig Erlam. He's a senior market analyst at OANDA in London. Welcome back to the program, Craig. Now, we saw better than expected GDP numbers out of China earlier this week, but the outlook there is not as bright as those numbers would suggest. What are we seeing from the leading indicators?
I think what was clear from the GDP data for the first quarter is that the first 2 months of the year was strong, and we saw some weakness going into the back end of the quarter. That's no surprise, given that we started to see lockdowns in parts of China, including Shanghai, and we're continuing to see severe restrictions across a number of different cities, and that's going to continue to be a major headwind for the Chinese economy. So I think that's the thing that really came out of that data, even though it did surpass expectations. Clearly now, China is going to really struggle to hit that growth target that it set itself for this year of 5.5%, unless we see some more ambitious stimulus measures from the Chinese regime.
Now, this slowdown in China, what kind of effects do you expect this to have on the global economy, considering the fact that China is just such a big manufacturing powerhouse for everybody?
Well, I think the lesson to learn from the last couple of years is that it can be severely disruptive as far as trade is concerned. So we start to see these major delays. We start to see higher prices. I think that to some extent, China has gone some way to try and shield that with regards to things like the ports issues that we saw back in 2020 and 2021. So some of these lessons have clearly been learned, but there's no denying that if we continue to see these kind of restrictions and lockdowns, then there is going to be further supply disruptions, and there are going to be higher prices as a result, and that's something that we're going to have to get used to until we start to see these restrictions being dropped.
Now, the government has been under pressure from the private sector to ease these restrictions. As we know, other major economies are starting to live with the virus. Do you expect China's insistence on keeping these measures in place to change the decision-making of multinationals? Should we expect them to divert investments away from China?
I think at this moment in time, there isn't going to be a major shift away from China just because the incredible expense that will come with such a decision as a reason why these companies are there in the first place. So I don't think there's going to be a massive shift. But if this continues to be the case and we expect and China insists on going down this path for many years to come, then I think companies will have no choice but start to look elsewhere. But that's a big if, because with the rollout of other alternative vaccines, we may start to see the Chinese leadership take a more relaxed approach as far as these lockdowns are concerned as time passes. And I think companies will probably stand by and wait in the interim to see how that does unfold. But let's not also ignore the fact that there's a big lesson that's been learned over the last 2 years by many of these companies in relation to their globalization efforts and just how much they want to be involved within this. I think that while there is massive benefits to be had from globalization, we've seen some of the downside over the last couple of years. And I think there's going to be many companies who are going to be maybe looking to diversify their supply chains a little bit more in order to stop them being so reliant, for example, on China alone, which could cause a major issues further down the road if they continue to go down this lockdown path.
All right. Craig Erlam, Senior Market Analyst at OANDA. Thank you for joining us with your insight.